Hey everyone, welcome to your Algo Lab. In our last episodes, we backtested long-term resampled moving average strategies. If you haven't seen them yet, we highly recommend checking them out. The links to the previous episodes are in the description below. Today we're going to backtest a new strategy, the moving average crossover. Here we have a 10-day moving average represented by the orange line and a 200-day moving average shown by the blue line. A buy signal is triggered when the short-term moving average crosses above the long-term moving average. This moving average crossover can serve as a method to filter trend signals. If we relied only on a simple 200-day moving average strategy, two false signals would have occurred. However, by implementing the moving average crossover, these false signals were avoided. When the 10-day moving average crosses below the 200-day moving average, we close the long position. Once again, we see that the moving average crossover strategy effectively avoided numerous false signals. If you enjoy our content, please like, subscribe, and hit the bell icon to stay updated with our latest research. Without further ado, let's start the backtesting. Backtesting long-term signals can be challenging because traditional backtesting methodologies don't work well on long-term indicators due to the limited number of signals triggered. To overcome this, we look for commonalities across different markets, which helps guide us in selecting reliable indicators. In this episode, we'll be examining equity indices from around the globe. In later episodes, we'll explore other asset classes as well. From the United States, we have the S&P 500, the Nasdaq, and the small cap Russell 2000. Moving to Canada, we have the TSX Composite. In Europe, our focus will be on the Euro Stoxx 50, the German DAX Price Index, the French CAC 40, Spain's IBEX 35, Italy's FTSE MIB, UK's FTSE 100, and the Swiss SMI. In Asia, we'll examine Japan's Nikkei 225, the Hong Kong Hang Seng Index, and Australia's ASX 200. We've collected data starting from 1980. For indices that began trading after this date, we've used the earliest available historical data. We've chosen price indices because reinvested dividends can distort the calculation of the long-term moving average. Let's set up our benchmark. Our benchmark will be a buy and hold strategy on equity price indices. Here are the benchmark buy and hold returns. For example, the benchmark buy and hold return on the S&P 500 was 9.00%. Just a quick reminder, this is the price return without including reinvested dividends. Returns are just one facet of an investment. We also need to consider risk. Our preferred measure for this is maximum drawdown, MDD. Maximum drawdown assesses the risk of an investment by representing the maximum observed loss from a peak to a trough in a portfolio before a new peak is achieved. In simpler terms, it shows the largest drop in the value of an investment from its highest point to its lowest point. For instance, the maximum drawdown in this example is minus 25%. Understanding maximum drawdown helps investors evaluate potential downside risk and determine appropriate position sizing. Here is our table of maximum drawdowns for the buy and hold strategy. For example, during the testing period, the S&P 500 experienced a maximum peak-to-trough loss of 56.78%. The Nasdaq saw a peak-to-trough loss of 82.90% during the dot-com bubble. Finally, we have our risk-adjusted measure, the maximum drawdown adjusted return. The MDD adjusted return is the ratio between the annualized return and the maximum drawdown. While it is not the only risk-adjusted measure, it is simple and effective. For our 10 200 moving average strategy, the entry price is assumed to be the next open price following the crossover, with a 0.2% commission factored in to cover trading costs. We've highlighted the stats where the 10 200 moving average crossover outperformed the benchmark for clarity. For instance, with the S&P 500, the strategy didn't outperform the benchmark in terms of return, but did achieve a smaller maximum drawdown. Overall, while the average indices underperformed in returns, they effectively reduced the maximum drawdown. This makes sense because they avoided the most extreme periods of bear markets. For risk-adjusted return, we see that the 10 200 moving average crossover performed better in risk-adjusted return for most of the indices. This consistency is what we're looking for as we want an indicator to be effective across similar assets. Let's compare our 10 200 moving average crossover strategy with the 10-month resampled moving average strategy, which we backtested and analyzed in episodes 4 to 6. In terms of return and risk, the 10 200 moving average crossover aligns closely with the 10-month resampled moving average. The 10 200 moving average crossover slightly lags in win rate, and has a marginally higher number of trades. When developing a successful system, we rarely rely on a single indicator. The first step is to establish a sufficiently large number of profitable indicators. Given this approach, we're satisfied with the results of the 10-200 moving average crossover. In the next episode, we'll conduct a simple grid search to explore whether we can further enhance our 10-200 moving average crossover strategy. If you like our channel, make sure to like, subscribe, and hit the bell icon to stay updated with our latest content. Thank you for watching, and see you next time.